Okay, this is the second part of Chapter 25. We'll expand more on CAPM and look at arbitrage pricing theory. We looked briefly at how betas are calculated. They come from running a regression of the returns on an asset against the returns on the market over some period of time. The slope of the resulting line is the beta coefficient. Here's an illustration of the calculation of beta using, in this case, only 3 years of data. Usually 2 to 5 years of monthly or weekly data would be used. The resulting line fitted to the data found a beta of 1.44. Different calculations of beta use slightly different sets of data. 1 to 2 years of weekly data versus 5 years of monthly data. Think about what this means for estimates of beta, which tend to be very noisy. 5 years of rolling data? What if the risk characteristics of the firm change this year? It won't be reflected in the beta calculations for some time. To mitigate this problem, some beta estimates are, quote, fundamentally adjusted, unquote, using the same type of fundamental analysis used by stock analysts. As a reminder, beta reflects the amount of market risk a particular asset or portfolio has versus the market, which has a defined beta of 1. Riskier means more volatile returns. Notice that in our regression example, the R-squared is 99%, an extremely high result. R-squared values for a single stock are usually much lower, though values in the 90% range are not uncommon for portfolios. The confidence interval shows the range within which we are confident the true value lies. For betas of individual stocks, the typical range is rather low, 0.5 to 1.5. For portfolios, the result is much stronger, 0.92 to 1.08. In Chapter 6, we looked at total or standalone risk versus market and diversifiable risk in terms of standard deviation. Here we're going to use variance. Broken down into components, we see the overall risk of an asset depends on its market risk plus an error term representing the diversifiable risk. Since CAPM was introduced in the early 1960s, many different test methodologies have been used to try to verify or discredit it. Recall our earlier discussion of the statistical problems related to testing CAPM, chief of which is the fact that we have only historical data to test an expectational model. That said, tests of the stability of beta and the slope of the SML have been pursued. The results have not been overly positive. The relationship between risk and realized returns does appear to be linear, but the slope was less than expected. There is some question concerning the total irrelevance of diversifiable risk, meaning perhaps beta is not the only measure of risk of interest to investors. While betas of portfolios are found to be relatively stable, those of individual securities are not found to be good predictors of risk. Richard Rolle seriously questioned attempts to test CAPM. Beyond the statistical problems, recall that CAPM used the expected return on the market portfolio, which is itself a theoretical construction. What should be included in this market portfolio? All stocks? Domestic stocks? What about foreign stocks? One such alternate approach to quantifying the risk-return relationship is arbitrage pricing theory. Arbitrage pricing theory was proposed by Stephen Ross in 1976. APT is significantly more complex than CAPM, allowing multiple factors to influence the risk-return relationship. CAPM is a single-factor model, beta. APT is a multi-factor model, with the factors not specified in advance. It's not in wide use due to its complex nature and the need to use factor loading to find the relevant factors. As stated, the problem with APT is its complexity. To replace CAPM, any alternative needs to be theoretically sound, verifiable, and easy to use and explain. This ends Chapter 25.